So beginning with types of residential mortgages. So starting with the conforming variety or what we call as agency loans. So these are the loans which meet the criteria which have been defined by uh, government sponsored agencies like Fannie Mae, Freddie Mae, Ginnie Mac, and etc. Now, the idea of originate to distribute model. Now, this is something which we have introduced ourselves in one of our previous videos as well. So the idea of originate to distribute model is a bank would create a mortgage. So that is, we know that the bank's core business is lending money. So they borrow money from depositors, and that money will be lent to businesses or to individuals who want to maybe purchase a housing property. So in the originate to distribute model, what a bank would try to do is the loan, whichever is sitting on their books, they would like to offload that loan, and that loan will be securitized into a tradable product. Once that loan has been securitized into a tradable product, that can be transacted in the broader market, and investors can take positions in those securities. So this is popularly what we call technically as the originate to distribute model, a very, very important concept when we talk of securitized products like MBS specifically. So most lenders are going to originate these loans and securitize these loans. They can sell all of these conforming loans to entities like Fannie and Freddie. Now, what are conforming loans? We'll understand by a few criteria which I mentioned below. So a few popular criteria which are used. Now, this is not an exhaustive list, but these are the important criteria which are reviewed by these government-sponsored agencies before they decide whether a certain loan is conforming to their requirements or not. One is loan limits. So in 2020, in the US, the maximum loan amount was roughly $510,000. And there are certain areas which are more expensive, where the demand for properties could be higher. So that's what we call as a high cost area. So that's where the maximum loan amount could go as high as $765,000. Next, we have an idea of a LTV or a loan to value ratio. So this gives an idea as to what is the loan amount versus the valuation for that particular property. So maybe the requirement of these agencies for confirming a certain loan could be around 80% for LTV. Then a debt to income ratio for the borrower. Now, debt to income ratio is important because it's important to know the income stream or have a fair idea of the kind of income which the borrower is going to generate, because that income is precisely going to be used for servicing the debt or the mortgage which the borrower is taking from the bank or from any financial institution. Next is the credit score of the borrower. So as we know, the idea of credit score is to understand the credit worthiness of a certain borrower. So once we look at a credit score, the bank or a financial institution or a lending institution knows what is the credit risk of that particular borrower, because bank's business is based on the idea of managing risk in the best way possible. And out of the three risks which we generally study, credit, market, and operational risk, credit risk happens to be a very significant section whenever it especially comes to the lending portfolio for banks. So banks are extremely careful whenever they do the review of the borrowers who come to them for lifting new loans. So one of the things which they study is the credit score. So this is also generally what we call as a part of the KYC process for the bank, or the know your customer type of a process. A very, very standardized process, but something which helps bank assign a certain risk weight to a certain borrower. So credit score for the borrower can be a requirement. So maybe those borrowers over a certain credit score would be eligible. And second can be documentation requirements. So it's required that the required documentation or things like the KYC documents, the financial statements or income statements for the borrower, those are in order. Tax returns can also be one more component which could be considered. Now, all of these may be covered as a part of documentation requirements. So if a borrower is meeting these requirements, then we would say that they qualify for this category or agency or the confirming loan type of categories. Next is a non-agency or the non-confirming loans. So there may be certain loans who may fail to meet certain criteria which are set by GSE. So we have already went through a few of the criteria which are followed. There can be a few more, as I mentioned earlier. But if we simply go to these websites of these agencies, we'll get to know the exact set of criteria. But the ones which are listed on the previous slide, those are the ones which are the most popular. Now, there can be certain loans which may not meet certain criteria. Now, these are what you call as non-conforming. Why non-conforming? Because they are not conforming to a certain requirements. So that's why they are classified as a non-agency type. Now, such loans who fail these kind of criteria, they cannot be purchased by GSEs, because you can imagine that the requirements of GSE, they are very, very stringent. So unless those requirements are met, they are simply not going to purchase. They are simply not going to purchase that kind of a loan. So these are what you call as a non-agency type. Now, those loans which fall under or which fail to qualify the eligibility criteria, which are set by GSEs, they may be funded by private lenders, and they are sold in what you call as a private label securities market or private label securitization market. Now, below are a few common types of non-conforming loans. So, if you recollect in the previous block diagram, we had written these names. So, let's understand what these are. So, jumbos imply that they are failing to meet one of the requirements. Maybe, as the name goes, jumbo is something which is large. So maybe the loan size limit is being breached. So so again, whether this happens, that's like a breach of the eligibility criteria which has been set by GSE. So naturally, they cannot. So they will not fall into the conforming loans category. So we call them as so jumbos are classified as a non-agency type. Next can be Alt A type of security. So again, they may fail to meet one of the criteria for conforming loans. As a result, maybe they can carry an interest rate that is higher than prime lending. So again, an important concept in banking when we talk of prime lending. So prime lending basically explains the kind of rate which a bank is going to charge to a certain borrower. So prime borrowers are always offered a better rate because the bank is comfortable with their credit worthiness, and the bank says that we don't expect, or maybe the probability assigned for default to such prime borrowers is comparatively lower. So the interest rate which is offered as a part of prime lending is very low and favorable from a borrower's point of view. But an Alt A loan could be such that the interest rate is higher than prime lending, but it's not as high as a subprime, because there is a second category which is mentioned here as the subprime loans. Now, what are subprimes? We are going to talk in a moment, but subprime loans are the ones which are more riskier. Now, we know that from a normal risk and return idea, if a bank is willing to lend to someone who is more risky from a credit risk point of view, they are naturally going to charge a higher amount. So something which you commonly observe in subprime. But Art A, we can imagine, is falling somewhere in between. So it's not as good as the prime lending section, but it's not as bad as the subprime section. It's somewhere falling in between. As a result, the interest rates which may be charged would be somewhere between these two boundaries. So that's what we call as Art A. Then there are subprime. Now, subprime loans are those which may fail multiple criteria. Now, a few criteria or a few examples around these are mentioned below. So firstly, borrowers can be of a very, very poor credit quality. So that's what we call as subprime. So when you say subprime, they are not really falling in the prime category, they are below the prime category. So they are considered as risky borrowers who have a sketchy credit history and who have a higher probability of defaulting in the future. Uh, Now, ARMs, or what we call as an adjustable rate mortgage. Now, this is something which we had briefly understood as a part of the block diagram. And if you recollect, I had mentioned that this variety had grown in popularity during the build up to the financial crisis. But after that, the interest in ARM variety has fizzled out. So again, why we classify them as subprime? Because an adjustable rate mortgages are such that the interest rates, whether they reset, they disproportionately reset to a certain interest rate which is not serviceable by a subprime borrower. So that's the problem. Maybe for the first couple of years, then that ARM could be very, very comfortable for a subprime borrower. But the moment that rate switches or resets, it becomes difficult for the subprime borrower to meet those requirements. So again, a risky variety which is classified as a part of the subprime category. So these are three common types of what we call as non-conforming loans or non-agency backed loans. Now let's understand a mortgage calculation, a simple mortgage calculation. So this is something which many of us may be familiar. So this might have been covered in our undergrad courses or maybe as a part of your postgrad courses. Now, the simple loan calculator. So we know that whenever we are doing any kind of a mortgage calculation, there are two components to it. One is an interest component and one is a principal component. And we know that a certain portion or what we call as a EMI. So many of us are familiar with the concept of EMIs, what we call as an easy monthly installment. So the idea of EMIs is to decide on a certain amount for each month which will be repaid by the borrower, and that amount we can imagine is a combination of interest plus the principal. Now, how exactly we determine the monthly payment for a certain fixed rate mortgage and how exactly do we build a schedule around interest and principal? That is something which we will study in this and the next slide. Now, firstly, the loan mortgage calculation is a bit different as compared to a plain vanilla bond. Now, we have covered plain vanilla bond as a part of our discussion video on fixed income. So we know the valuation equation for a plain vanilla bond. So we have, let's say we have a plain coupon paying bond. So that bond is going to pay periodic coupons, and in the end, we have a final face value which gets paid out. So that's what we call as a bond. But for a loan mortgage, the behavior is slightly different. So for a loan, we do not have this kind of a large balloon payment in there. That doesn't exist. So imagine that the face value for the bond was 100. So that 100 gets paid at maturity. So imagine that the loan value is also 100. So for a loan, we do not keep that 100 right until the maturity date of the loan. That doesn't happen. So that's how your loan mortgage calculation is different. That 100 is going to keep on decreasing over the period of the loan. So that's what we call as a mortgage calculator. Now, how a mortgage calculator works, we'll see. So, but before we go there, we need to know how to figure out the monthly payment for a certain mortgage. So, uh, we have been given, so this color is, so this has been highlighted in red, the monthly payment, something which we intend to calculate. And uh, we have we have a certain interest rate which we are using or what we are referred to as Y. The B0 is the starting principal amount and these are the time periods. Now, how exactly to use this formula in practice, we'll see through a simple example. And later on, we'll extend this to creating a certain schedule of interest and principal payments for a mortgage. Now, as mentioned earlier, monthly payments will comprise of interest and principal components. In the early years, the interest component is going to dominate the principal payment. That's expected, isn't it? Because at the start or maybe at the initial portion of the loan, the principal payment or the principal outstanding, as we call it, that is high. And whatever interest is calculated gets calculated on the outstanding principal. So maybe on the very first month, since we have taken the loan, that interest component will be based on the entire loan notional. Now, let's say we compare this versus something which is maybe 30 months down the line. So then we'll see that there is a significant drop in the, or maybe there's at least a certain drop which has happened in the principal outstanding. So naturally, the interest component is going to decrease. So what we generally see is in the initial years, the interest component is going to be high and the principal component is going to be low. So I can just write it here. So initial and latter part of the loan. So in the initial part, let's say we have a I and a P. Initial part, interest component is going to dominate, principal will be comparatively lower, whereas in the latter parts, the interest component will be smaller and the principal component will be higher. So this is the trend which we'll see as a part of our sample calculation as well. Now to understand how to solve for this monthly payment, we'll take a simple example. Now, our idea is to calculate a monthly payment for a certain fixed rate mortgage. We'll take a starting notional amount of $100,000. Let's take the mortgage interest of 5% with the monthly compounding, something which is very, very common. And loan maturity, we'll take it as 30 years, which is again a very, very common tenor for housing loans. Now to apply the formula which has been given, we'll simply plug in numbers. So we have 100,000, which is the starting notional, which we had referred to as B0 as a part of the earlier formula. Then the monthly payment, this is something which is what we are trying to calculate. And on the right, we have these individual monthly payments which have been which we'll be solving for. Now again, through our financial calculator, these kind of calculations become very, very easy. So if we simply plug in the numbers, we directly get a monthly payment amount. So for this, I've used a financial calculator. You can verify this through a simple Excel as well, but through a financial calculator, it makes your life easy and saves a lot of time as well. On the exam, yes, you'll be required to use that calculator. So yes, I mean, that is something which you need to be comfortable with. Now, if we solve the above, now we have just one unknown, right? We have the monthly payment which we are trying to figure out. So after plugging in numbers and solving for monthly payment, that comes out to $536.82. So $536.82. So this is the monthly payment. Now, monthly payment is like a constant payment which will happen each month. But again, as I mentioned earlier, there will be a combination of interest and principal components which will make up this monthly payment. So how exactly do we calculate these? We try to understand through a simple example, and which will basically introduce us to what you call as a schedule for mortgage payments as well. So on the left hand side, uh, we will be doing the calculation. We have demonstrated the steps on the right. So we have each months. So we are starting months from 0 up till 360. Naturally, for 0, that is the time we are taking the loan. So our first payment will happen at month 1. Then we have one column which says total. So if you see, this 536.82 is something which we have just calculated. So if I just go up for a moment, this is the exact same monthly payment which you have calculated. So this amount total is going to remain constant. Now, how exactly it will be bifurcated between the interest and principal, that will keep on changing based on passage of time. So let's try to understand how to handle this. So let's see what we do for month 1. So we have already populated the numbers here. So how do we populate the interest and principal amounts? That's what we'll try and understand. So we are using a mortgage rate of 5% in our calculation, and it's monthly compounding. So 5% by 12 into 100,000, which is our starting outstanding notional on the loan. So that gives us $416.67. Now to calculate the principal component, what I can do is I can subtract the interest part from the amount 536.82, which what I call as a monthly payment. So principal will be nothing but this monthly payment of $536.82 minus 416 and 67 cents. So that gives us 120.15. So this is the principal payment required in month 1. So these are the numbers which you populate here. This is 416.67 right here, and we have the 120.50 which we write here. Now, we need to adjust the ending principal balance because a certain principal is getting repaid, and the principal repaid here is $120.15. So the ending notional will come down by that much quantum. So 100,000 minus $120.15 brings us to $99,879.85. That's what we write here. So now this becomes the new notional. So when we do the calculation for month 2, we'll see that we are using this new ending principal balance to calculate our interest and other related calculations. So let's see what happens at month 2. Now again, we do the interest calculation similarly. Now only difference between this is we have to use the updated notional. So we don't use 100,000 anymore. We use 99,879 and 85 cents. So that gives us an interest payment of $416.17. So that's what we write here. Now again, the monthly payment doesn't change. That remains at 536.82. So how much would be the principal repaid? That will be the monthly payment of $536.82 minus the interest payment, which is $416.17. That comes out to $120.65. That is what we mentioned here as a principal or the principal repaid. Now again, this ending principal balance needs to be adjusted downwards because a principal payment of $120.65 is happening. So the ending principal will be the current principal minus the principal repaid. So that brings the outstanding principal down to $99,759.19. So this is a similar calculation which you can apply for every month going forward, right until maturity, which is 30 years. So we have a 30-year loan, so we have 360 months. So here, if we see, so and these calculations are similar, so these steps in between have not been shown, but approach remains the same. Now, if we see the interest component, that is gradually dropping over time. Now, this is something which we had discussed a while back. Now, why the interest amount is dropping? Because the ending principal balance is dropping, and whatever is the interest payment, that is calculated based on how much is the ending principal balance. As the ending principal balance drops, the interest component drops, and if the interest component drops, naturally the principal component is going to rise, isn't it? Because finally we have to make a payment of 536.82 no matter what. So if the interest portion is dropping, the shortfall of this will be made up by the principal. So that's why the principal repaid towards the end of the loan or towards the latter part of the loan's life, that is higher. Now that is something which is evident on month 360. So here we observe that the interest payment is just 2.23, whereas the principal payment is 530, close to $535. So this is the trend which we see in the interest and principal repayments which happen as a part of the mortgage calculations. So again, a very, very handy and a simple calculation, something which may appear on the examination, but otherwise as well, in case any one of you decides to purchase a housing or maybe commercial property going ahead, you'll know exactly what the calculation works. So the bank may show you a certain schedule. So you'll be able to understand that far better once you have a good understanding of this calculation. Now, understanding the idea of prepayments, which happens in mortgages. Now, this is something which is very, very common whenever we talk of any kind of mortgage repayments which borrowers do to banks. So, prepayment is a feature which you will commonly observe. So, a prepayment of a loan implies that the borrowers would want to prepay the loan due to a host of reasons. Now, this results in the change to the initial loan period. Now, in our earlier example, we had taken a very simple example whereby we had taken a fixed rate loan of 30 years and we had done a simple calculation. But in reality, the borrowers always have an option to prepay the loan. And if they decide to prepay the loan, that is going to curtail the overall loan period. Now, when we talk of prepayment of mortgages, we try to study them in two broad categories. One is turnover. So, what do we mean by turnover? Is this is the acceleration in payment of loan principal whenever the homeowner decides to sell the property. So again, technically also called as a due on sale clause. So in case a homeowner decides to sell off their house, then that will result in a sudden repayment of loan principal. Now there are multiple factors which borrowers might have in mind when they go in for a loan turnover. So a few reasons as to why someone might want to sell their house. Firstly, uh, there are seasonality factors. So generally, family homes are something which may get sold during summer or springtime. So there's a rationale behind that. So it may so happen that the neighborhood or the neighborhood district would have a better school district where maybe the kids can go to school. So families might decide to move to that new neighborhood. So that may result in selling off a property and then buying a new one. So this is what you call as seasonality, where families move from one area or neighborhood to another, especially during spring or summer break for schools. Next could be family circumstances. So maybe someone could be in dire requirement of funds, possibly. Maybe that someone has a very heavy medical expense, which maybe the insurance is not sufficient to meet, or maybe there is an unfortunate bereavement in the family, which has resulted in maybe a division of assets within the family, or possibly other things like maybe switching for new jobs. Now, people always move around, right? Because if a certain good job comes up, people would always want to pursue that because everyone would want to have a progression in their career profile as well. So, in case that happens, if someone decides to switch jobs and move to a new city, that may result in them selling off a property which they are currently holding and then move to a new city. So, that's what you can classify as maybe a family circumstance. Next is refinancing of mortgages. Now, the idea of refinancing is indicates that there is always an increased activity in mortgage prepayment whenever the interest rates drop or whenever the interest rates decrease. Now, generally, two things which we study whenever we talk of refinancing. One is the rate and term refinance, where the borrowers or the home loan borrowers are going to take advantage of the lower rates and prepay loans. Now, that is always advantageous, isn't it? Because if the borrower has a chance to prepay the loan, that basically implies that they are able to retire the principal at a faster rate possibly. So that way their loan period gets curtailed. So that helps them save on their interest payments, which may happen at a future period of time. So that's what we call as a rate and term refinancing, something commonly observed in a low interest rate scenario. Next is a cash out refinancing. So a cash out refinancing basically implies that the borrower might want to take out or liquidate a certain portion of their own equity for a variety of reasons. So common reasons for this could be maybe refurbishing the house, or maybe renovating or remodeling the house to make it something better than the condition in which it was purchased. So a cash out refinancing is not really dependent on a lower interest rate regime. Now that is something which is more dependent on the borrower's choices, I would say. But nonetheless, two important items which we study under refinancing. One is the rate and term financing and cash out. Now, a few factors which may influence refinancing. Now, firstly, level of interest rates which are prevailing in the market. Now, whenever the interest rates are lower, there is always a higher probability of prepayment happening. So we'll observe that there'll be more amount of refinancing which happens whenever in a dropping interest rate environment. Then change in the borrower's credit profile. So if the borrower can improve their credit profile, that naturally makes them eligible for a lower interest rate on the loan, which is an advantage for them, which can also trigger that they may want to prepay their loan because they may want to take advantage of the lower interest rates which are being offered to them, and this will help them repay the loan at a faster rate. Now, increasing property value, so this will naturally reduce the LTV ratio, something which we had discussed as a part of eligibility criteria for confirming loans. So that's the exact same LTV thing. Uh, and also housing prices. Now, whenever the housing prices rise, then the homeowners are very likely to take out their equity. So that can be another reason which can influence the overall refinancing, which happens for mortgages. Also, a couple of other points. One is the age of the mortgage pool. Now, when we say age of the mortgage pool, that talks about the time which has passed since the mortgage has been lifted. So, generally, in the younger years of a mortgage, or in the early years, as we call it, the interest component is larger as compared to the principal component, something which you have seen as a part of the calculation schedule, which you have seen some time back. Now, by prepaying, the borrowers can save on the interest cost, definitely. However, generally what happens is during the early years for the loan, it becomes expensive for borrowers to refinance. So generally we'll observe that for younger mortgages or for early age mortgages, the amount of refinancing which happens is comparatively lower. But maybe in a latter part, that could change. Then there's a burnout effect. So a burnout effect generally talks about a mortgage pool. And whenever we talk of a mortgage pool, we know that there are multiple borrowers which are there in a pool. So imagine that mortgage pool has a mix of borrowers with different ages of their mortgages. So maybe someone who has been in that pool for maybe the last 10 years, or someone who is a new entrant, etc. So we can have different categories of borrowers which are falling within this what we call as a mortgage pool. Now, mortgage pool ages or it becomes old over a period of time. That's simply the impact of passage of time. Now, during this time period, older borrowers might have already taken the benefit of refinancing in the past. And it may so happen that such borrowers might have taken the advantage a few times, maybe twice or thrice in the past. So that way, they may not be inclined to again refinance their loan because they have already reaped the benefits of refinancing in the past. And as I mentioned, they could have done it multiple times in the past. So naturally, there may not be too much of an inclination from such borrowers to again go in for refinancing. So this is technically what we call as a burnout effect in a older mortgage pool or as the mortgage pool ages.